Question 1. Which of the following statements is true regarding open-end investment companies? A. They issue a fixed number of shares and trade on exchanges. B. Shares are bought and sold directly from the company and are always redeemable. C. Their shares are subject to supply and demand and may trade at a premium or discount to NAV. D. They primarily invest in illiquid assets and have limited redemption options. Answer: B. Shares are bought and sold directly from the company and are always redeemable. Open-end investment companies, commonly known as mutual funds, continuously issue new shares and stand ready to redeem their outstanding shares. This means investors buy shares directly from the fund company and sell them back to the fund, always at the current net asset value, NAV, plus any applicable sales charge for purchases, or minus any deferred sales charge for redemptions. Unlike closed-end funds, mutual fund shares do not trade on secondary markets. Their structure ensures liquidity for investors. Question 2. An investor purchases a mutual fund with a front-end load. The sales charge is deducted from the A. Net asset value, NAV, per share at the time of redemption. B. Total investment amount before the shares are purchased. C. Dividends and capital gains distributions received by the investor. D. Management fees charged by the fund's investment advisor. Answer: B. Total investment amount before the shares are purchased. A front-end load, also known as a Class A share sales charge, is deducted from the investor's total investment amount before shares are purchased. For example, if an investor puts in $10,000 and the front-end load is 5%, then $500 is deducted, and $9,500 is used to purchase shares at the NAV. This means the investor buys fewer shares initially due to the upfront cost. Understanding how different sales charges impact an initial investment is crucial for mutual fund investors. Question 3. The separate account of a variable annuity is primarily used to A. Guarantee a fixed rate of return to the annuitant. B. Hold the general assets of the insurance company. C. Invest in a portfolio of securities chosen by the annuitant to seek growth. D. Fund the insurance company's administrative expenses. Answer: C. Invest in a portfolio of securities chosen by the annuitant to seek growth. The separate account of a variable annuity holds the assets that are invested in various sub-accounts, such as stock, bond, or money market portfolios, chosen by the annuitant. Its purpose is to allow for potential growth based on market performance, and it is distinct from the insurance company's general account. Because the value fluctuates with the performance of the underlying investments, the annuitant assumes the investment risk. This structure allows for customization and market participation within the annuity wrapper. Question 4. According to FINRA rules, when must a mutual fund prospectus be delivered to an investor? A. Only upon request by the investor, after the purchase. B. Within 30 days of the fund's fiscal year end. C. At or before the time of sale. D. Annually, along with the fund's financial statements. Answer: C. At or before the time of sale. A mutual fund prospectus, specifically the statutory prospectus, must be delivered to an investor at or before the time of sale. This is a fundamental requirement under the Securities Act of 1933 and Investment Company Act of 1940, designed to ensure investors have access to all material information before making an investment decision. While summary prospectuses are also used as a delivery mechanism, the statutory prospectus remains the definitive legal document that must be made available. Ensuring timely delivery is a critical responsibility for registered representatives. Question 5. Which of the following is considered a registered representative's primary concern when recommending a variable annuity? A. The highest possible commission generated from the sale. B. The client's ability to tolerate surrender charges. C. The client's existing life insurance coverage. D. The client's financial situation, investment objectives, and risk tolerance. Answer, D. The client's financial situation, investment objectives, and risk tolerance. When recommending any security, including a variable annuity, a registered representative's primary concern must be the suitability of the investment for the client. This involves a thorough understanding of the client's financial situation, investment objectives, and risk tolerance. All recommendations must be based on what is in the best interest of the customer, not on potential commissions or other secondary factors. FINRA's suitability rules emphasize this client-first approach to ensure appropriate investment choices. Question 6. A mutual fund has total assets of $100 million, liabilities of $10 million, and 5 million shares outstanding. What is the net asset value, NAV, per share? A. $20.00. B. $18.00. C. $22.00. D. $19.00. Answer, B. $18.00. The net asset value, NAV, per share is calculated by subtracting a fund's liabilities from its assets and then dividing by the number of outstanding shares. In this case, the total assets are $100 million and liabilities are $10 million, resulting in net assets of $90 million, $100M, $10 million. Dividing $90 million by 5 million shares outstanding yields an NAV per share of $18.00. This daily calculation determines the price at which mutual fund shares are bought and redeemed. Question 7. Which of the following is a key characteristic of a 12b(1) fee in a mutual fund? A. It is a one-time charge deducted at the time of purchase. B. It is an annual fee used to cover distribution and marketing expenses. C. It is a fee deducted only upon redemption of shares. D. It is a management fee paid directly to the fund's portfolio manager. Answer, B. It is an annual fee used to cover distribution and marketing expenses. A 12b(1) fee is an annual fee charged by a mutual fund to cover its marketing and distribution expenses, including commissions paid to registered representatives for selling the fund. This fee is deducted directly from the fund's assets and is expressed as a percentage of the fund's average net assets. While 12b(1) fees are ongoing, FINRA limits the maximum amount that can be charged for this purpose. Investors should be aware of these recurring costs as they can impact overall returns. Question 8. An investor who currently owns ABC Mutual Fund decides to purchase more shares, qualifying for a lower sales charge based on their accumulated purchases. This is an example of A. An exchange privilege. B. A breakpoint sale. C. Rights of accumulation. D. A letter of intent, LOI. Answer, C. Rights of accumulation. Rights of accumulation allow investors to qualify for reduced sales charges on new purchases by combining the value of existing shares held in the fund with the value of the new purchase. This benefit is applied when the total value reaches a breakpoint level, typically without a time limit. It rewards long-term investors by allowing their growing account balance to help them achieve lower sales charges on subsequent investments. This differs from a letter of intent, which involves a future commitment. Question 9. A letter of intent, LOI, in a mutual fund allows an investor to A. Sell their shares back to the fund without any sales charge. B. Purchase shares at a discounted NAV for a future period. C. Commit to investing a specified sum over a future period to qualify for a breakpoint. D. Transfer their mutual fund shares to another fund within the same family without charge. Answer, C. Commit to investing a specified sum over a future period to qualify for a breakpoint. A letter of intent, LOI, is a non-binding agreement by an investor to purchase a sufficient amount of mutual fund shares over a 13-month period to qualify for a lower sales charge breakpoint. The investor immediately benefits from the reduced sales charge on current purchases, with the understanding that if the commitment is not met, the higher sales charge will be retroactively applied. This mechanism allows investors to reduce sales charges based on anticipated future investments. Failure to meet the LOI could result in shares being escrowed to cover the higher sales charge. Question 10. When a mutual fund investor redeems shares, the payment must typically be made within how many business days? A. 1 business day. B. 3 business days. C. 5 business days. D. 7 calendar days. Answer, D. 7 calendar days. When a mutual fund investor redeems shares, the Investment Company Act of 1940 requires that the payment for the redeemed shares must be made by the fund within 7 calendar days of the redemption request. This rule is designed to ensure liquidity for mutual fund shareholders. While some funds may process redemptions faster, 7 calendar days is the maximum allowed timeframe for payment. This provision provides investors with a predictable timeline for accessing their invested capital. Question 11. An investor receives a capital gains distribution from a mutual fund. For tax purposes, this distribution is generally treated as A. Ordinary income. B. Tax-exempt income. C. Long-term capital gains, regardless of how long the investor held the fund shares. D. Short-term capital gains, if the investor held the fund shares for less than 1 year. Answer, C. Long-term capital gains, regardless of how long the investor held the fund shares. Capital gains distributions from mutual funds are typically treated as long-term capital gains by the IRS, regardless of how long the individual investor has owned the mutual fund shares. This is because the fund itself often holds the underlying securities for more than 1 year before selling them for a gain. Dividends, on the other hand, are generally taxed as ordinary income or qualified dividends depending on the underlying source. Understanding the tax treatment of distributions is key for financial planning. Question 12. Which of the following is a primary characteristic of a unit investment trust, UIT? A. Actively managed portfolio with a changing composition. B. Shares traded on a secondary market like an exchange. C. Fixed portfolio of securities with no active management and a specified termination date. D. Continuously offered shares with daily NAV pricing. Answer, C. Fixed portfolio of securities with no active management and a specified termination date. A unit investment trust, UIT, is characterized by a fixed portfolio of securities that is not actively managed, and it has a specific termination date. Once the portfolio is established, it generally remains unchanged, which means there is no investment advisor making ongoing buying and selling decisions. This passive management structure leads to lower operating expenses compared to actively managed mutual funds. UITs offer a diversified, unmanaged portfolio for a set period, providing predictable investment exposure. Question 13. In a variable annuity, what does the assumed interest rate, AIR, represent? A. The minimum guaranteed rate of return during the accumulation phase. B. The fixed interest rate applied to the separate account investments. C. A benchmark rate used to determine the value of accumulation units. D. The rate of return that, if exceeded, will result in an increased payout during the annuity phase. Answer, D. The rate of return that, if exceeded, will result in an increased payout during the annuity phase. The assumed interest rate, AIR, in a variable annuity is a hypothetical rate of return that the insurance company uses to calculate the initial annuity payment and subsequent payments. If the actual performance of the separate account investments exceeds the AIR, the next annuity payment will be higher than the previous one. Conversely, if the actual performance is less than the AIR, the payment will decrease. The AIR is crucial in determining how variable annuity payouts fluctuate once annuitization begins. Question 14. A mutual fund investor who signs a letter of intent, LOI, may backdate it for how many days? A. 30 days. B. 60 days. C. 90 days. D. 120 days. Answer, C. 90 days. An investor can backdate a letter of intent, LOI, up to 90 days to include previous purchases in the calculation of the breakpoint. This allows an investor to count investments made up to 3 months prior towards meeting the total investment amount specified in the LOI. Backdating can be beneficial if the investor made a significant purchase shortly before deciding to commit to a larger investment goal. This flexibility helps investors maximize their breakpoint discounts. Question 15. Which of the following describes the breakpoints in mutual fund sales? A. Periods during which a mutual fund's NAV is exceptionally low. B. Specific investment amounts at which investors qualify for reduced sales charges. C. The maximum percentage of assets a fund can invest in a single security. D. Thresholds for determining capital gains distributions. Answer, B. Specific investment amounts at which investors qualify for reduced sales charges. Breakpoints are specific investment levels at which mutual funds offer reduced sales charges. As an investor's total investment reaches these predefined thresholds, the percentage of the front-end load decreases. Registered representatives have an obligation to inform clients about these breakpoints to prevent breakpoint sales, which involves selling shares just below a breakpoint to earn a higher commission, thereby denying the client a reduced sales charge. Understanding breakpoints is essential for maximizing investor value. Question 16. A FINRA registered representative must complete the regulatory element of continuing education, CE, how often? A. Annually. B. Every 2 years. C. Every 3 years. D. Every 5 years. Answer, C. Every 3 years. Registered representatives must complete the regulatory element of continuing education, CE, within 120 days of their second registration anniversary and every 3 years thereafter. The regulatory element focuses on rules and regulations, ethical requirements, and other topics critical to maintaining professional standards. This ongoing education requirement ensures that registered representatives stay current with industry regulations and best practices, protecting investors and maintaining market integrity. Question 17. Which of the following is typically not a characteristic of a money market mutual fund? A. Seeks to maintain a stable net asset value, NAV, of $1.00 per share. B. Invests in short-term debt instruments. C. Offers check-writing privileges. D. Provides long-term capital appreciation as its primary objective. Answer, D. Provides long-term capital appreciation as its primary objective. Money market mutual funds are designed to provide liquidity, safety, and current income by investing in short-term debt instruments such as treasury bills, commercial paper, and certificates of deposit. Their primary objective is capital preservation and liquidity, typically seeking to maintain a stable $1.00 NAV. They are not intended for long-term capital appreciation, which is generally the goal of equity or balanced funds. Understanding their limited scope is crucial for appropriate asset allocation. Question 18. Which of the following mutual fund share classes typically has a front-end load and lower 12b(1) fees? A. Class A shares. B. Class B shares. C. Class C shares. D. Class D shares. Answer. A. Class A shares. Class A shares typically feature a front-end sales charge, low D, paid at the time of purchase, but generally have lower ongoing annual 12b(1) fees and often offer breakpoints for larger investments. Class B and C shares, on the other hand, usually have no front-end load but feature higher 12b(1) fees and potentially contingent deferred sales charges, CDSCs, upon redemption. Understanding the fee structure of each share class is critical for investors to choose the most cost-effective option based on their investment horizon and amount. Question 19. The primary purpose of a mutual funds custodian bank is to A. Manage the fund's investment portfolio. B. Promote and distribute the fund's shares. C. Hold the fund's assets in safekeeping. D. Process shareholder transactions and mail distributions. Answer, C. Hold the fund's assets in safekeeping. The primary role of a mutual funds custodian bank is to hold the fund's assets, e.g., securities, cash, in safekeeping, preventing theft or misuse. The custodian bank is typically a large commercial bank and acts as an independent entity separate from the fund's investment advisor and principal underwriter. This segregation of duties provides a critical layer of protection for investors, ensuring that the fund's assets are properly accounted for and safeguarded. They also handle administrative tasks related to asset custody. Question 20. Under the Investment Company Act of 1940, a mutual fund must send financial statements to shareholders at least A. Monthly. B. Quarterly. C. Semiannually. D. Annually. Answer, C. Semiannually. The Investment Company Act of 1940 requires mutual funds to send financial statements to their shareholders at least semi-annually, twice a year. These statements include detailed information about the fund's performance, holdings, and financial condition. This requirement ensures that shareholders are regularly informed about the operations and financial health of the fund they have invested in, promoting transparency and allowing for informed decision-making. These statements are distinct from the annual prospectus update. Question 21. An investor owns shares in a variable annuity and decides to surrender it during the accumulation phase. Which of the following may apply? A. A guaranteed minimum withdrawal benefit. B. No tax implications. C. A surrender charge. D. A fixed annuity payment. Answer, C. A surrender charge. If an investor surrenders a variable annuity during the accumulation phase, they may be subject to a surrender charge. This charge is a penalty imposed by the insurance company for early withdrawals and typically declines over a specified period, known as the surrender charge period. Surrender charges are designed to compensate the insurer for costs associated with issuing the contract. Additionally, any gains realized from the surrender would be taxable as ordinary income, and if the investor is under 59.5, a 10% penalty tax may apply. Understanding these potential costs is crucial before investing. Question 22. Which of the following is an advantage of investing in a mutual fund compared to buying individual stocks? A. Direct control over individual stock selection. B. Lower overall fees and expenses. C. Professional management and diversification. D. Guaranteed returns in all market conditions. Answer, C. Professional management and diversification. Mutual funds offer investors professional management, as their portfolios are managed by experienced investment advisors. They also provide instant diversification, as a single mutual fund investment typically spreads money across many different securities, reducing unsystematic risk. While mutual funds do have fees, the benefits of professional management and diversification are often cited as key advantages for individual investors who may lack the time, expertise, or capital to build and manage a diversified portfolio of individual stocks. Returns are never guaranteed. Question 23. The conversion of accumulation units to annuity units in a variable annuity contract occurs at A. The time of initial investment. B. The annuitization date. C. The death of the annuitant. D. Any time the market value of the separate account changes. Answer, B. The annuitization date. The conversion of accumulation units to annuity units in a variable annuity contract occurs at the annuitization date. During the accumulation phase, contributions purchase accumulation units, and their value fluctuates with the separate account's performance. When the annuitant chooses to begin receiving payments, annuitize, the accumulation units are converted into a fixed number of annuity units. The value of these annuity units then fluctuates based on the separate account's performance relative to the assumed interest rate, AIR, determining the actual payout amount. This transition marks the shift from saving to receiving income. Question 24. A mutual fund's expense ratio is calculated as A. Total assets divided by total liabilities. B. Total expenses divided by average net assets. C. Total sales charges divided by total assets. D. Net investment income divided by shares outstanding. Answer, B. Total expenses divided by average net assets. A mutual fund's expense ratio is calculated by dividing the fund's total annual operating expenses, such as management fees, administrative fees, and 12b-1 fees, by its average net assets. This ratio expresses the percentage of the fund's assets that are used to cover operational costs each year. A lower expense ratio generally means more of the fund's returns go to investors. Understanding and comparing expense ratios is crucial for investors evaluating the long-term costs of mutual funds. Question 25. Which of the following statements about a variable life insurance policy is true? A. It offers a guaranteed cash value and death benefit. B. The policyholder bears the investment risk of the separate account. C. It is regulated solely by state insurance departments. D. Premiums are invested in the insurance company's general account. Answer, B. The policyholder bears the investment risk of the separate account. In a variable life insurance policy, the policyholder bears the investment risk because the cash value and death benefit, above a guaranteed minimum, fluctuate based on the performance of the underlying investments in the separate account. Unlike traditional whole life insurance, there is no guaranteed cash value. Because variable life policies involve securities, they are regulated by both state insurance departments and the SEC/FINRA. Premiums, after deductions, are primarily directed to the separate account. This structure provides potential for growth but also carries market risk. Question 26. When recommending a switch from one mutual fund to another, a registered representative must primarily ensure A. The new fund has a higher management fee. B. The switch generates a higher commission. C. The switch is suitable for the client and provides a legitimate investment benefit. D. The client pays a new sales charge. Answer, C. The switch is suitable for the client and provides a legitimate investment benefit. When recommending a switch from one mutual fund to another, especially within a short period, a registered representative has a heightened suitability obligation. The representative must primarily ensure that the switch is suitable for the client's investment objectives, risk tolerance, and financial situation, and that it provides a legitimate investment benefit. The representative must consider all costs, including new sales charges, and explain the advantages and disadvantages. Churning or switching funds unnecessarily to generate commissions is a serious violation of FINRA rules. Question 27. A FINRA member firm must maintain records for customer account statements for a minimum of A. 3 years. B. 5 years. C. 6 years. D. Indefinitely. Answer, C. 6 years. FINRA rules generally require member firms to maintain records of customer account statements for a minimum of 6 years. This record-keeping requirement helps ensure proper oversight, facilitate regulatory examinations, and provide documentation in case of disputes. Other types of records may have different retention periods, for example, 3 years for most general communications, 5 years for AML records, but 6 years for statements. Adhering to these retention periods is crucial for regulatory compliance. Question 28. An investor would likely invest in a municipal bond fund primarily for A. High growth potential. B. Taxable income. C. Tax-exempt income. D. Short-term capital preservation. Answer, C. Tax-exempt income. Investors typically choose municipal bond funds primarily for the tax-exempt income they offer. The interest earned on municipal bonds is generally exempt from federal income tax, and often from state and local taxes if the investor resides in the issuing state. This tax advantage makes municipal bond funds particularly attractive to investors in higher tax brackets seeking to maximize their after-tax returns. While capital preservation is also a factor, the primary driver is usually the tax-free income stream. Question 29. What is the primary risk associated with investing in bond funds? A. Credit risk and interest rate risk. B. Liquidity risk and currency risk. C. Market risk and political risk. D. Inflation risk and reinvestment risk. Answer. A. Credit risk and interest rate risk. The primary risks associated with investing in bond funds are credit risk and interest rate risk. Credit risk is the possibility that the bond issuer will default on its payments, while interest rate risk refers to the sensitivity of bond prices to changes in interest rates. When interest rates rise, the value of existing bonds with lower fixed interest rates typically falls. Investors in bond funds need to understand that even safe investments carry these inherent risks, which can impact the fund's NAV. Inflation and reinvestment risk are also factors, but credit and interest rate risk are paramount for bonds. Question 30. A prospectus for a variable annuity must disclose that the contract's value A. is guaranteed to increase over time. B. may increase or decrease depending on the performance of the separate account. C. is invested only in government-backed securities. D. provides a fixed return during the accumulation phase. Answer, B. may increase or decrease depending on the performance of the separate account. The prospectus for a variable annuity must clearly disclose that the contract's value may increase or decrease depending on the investment performance of the underlying subaccounts in the separate account. This is a critical disclosure because variable annuities carry investment risk, unlike traditional fixed annuities. There are no guarantees of growth, and investors can lose money. This transparency ensures investors understand the market-dependent nature of their investment. Question 31. Under what circumstances may a registered representative share in the profits or losses of a customer's account? A. Under no circumstances. B. With prior written consent from the customer only. C. With prior written consent from the customer and the firm. D. Only if the representative also contributed capital to the account. Answer, C. With prior written consent from the customer and the firm. A registered representative may only share in the profits or losses of a customer's account if they have obtained prior written consent from both the customer and their employing FINRA member firm. Additionally, the sharing must be proportionate to the registered representative's financial contribution to the account, unless the representative is a member of the customer's immediate family. This rule prevents conflicts of interest and ensures transparency in profit-sharing arrangements. Question 32. The process of reinvesting income and capital gains distributions back into additional shares of a mutual fund is known as A. Dollar cost averaging. B. A systematic withdrawal plan. C. Accumulation. D. Compounding. Answer, D. Compounding. The process of reinvesting income and capital gains distributions back into additional shares of a mutual fund is a form of compounding. Compounding allows these earnings to generate further earnings, leading to potentially significant growth over time. While dollar cost averaging involves making regular, fixed dollar investments, and systematic withdrawal plans involve taking out regular payments, reinvesting distributions is specifically about growing the existing investment base through the power of compounding. This is a common strategy for long-term investors seeking to maximize returns. Question 33. A registered representative is primarily responsible for ensuring that all information provided to clients about securities products is A. Approved by the SEC. B. Free of complex financial jargon. C. Fair, balanced, and not misleading. D. Guaranteed to lead to investment success. Answer, C. Fair, balanced, and not misleading. A registered representative is primarily responsible for ensuring that all information provided to clients about securities products is fair, balanced, and not misleading. This is a fundamental principle of FINRA's communications rules, designed to protect investors from false or exaggerated claims. While clear language is desirable, the core requirement is accuracy and completeness, avoiding any statements that could mislead an investor about risks or potential returns. Representatives must avoid making guarantees or unsubstantiated projections. Question 34. Which of the following would not be considered suitable for an investor seeking highly conservative, short-term capital preservation? A. Money market fund. B. Short-term government bond fund. C. Aggressive growth stock fund. D. Certificates of deposit, CDs. Answer, C. Aggressive growth stock fund. An aggressive growth stock fund would not be suitable for an investor seeking highly conservative, short-term capital preservation. These funds invest in companies with high growth potential but also carry significant market risk and volatility, making them inappropriate for short-term preservation goals. Money market funds, short-term government bond funds, and certificates of deposit, CDs, are all generally considered more conservative options suited for capital preservation due to their low risk profiles and focus on short-term stability. Question 35. The purpose of the free look provision in a variable annuity contract is to allow the purchaser to A. Exchange the annuity for a different type of insurance product. B. Withdraw a portion of the contract value without penalty. C. Terminate the contract within a specified period for a full refund of premiums paid. D. Switch investment options within the separate account without charge. Answer, C. Terminate the contract within a specified period for a full refund of premiums paid. The free look provision, also known as the right of rescission, allows a purchaser of a variable annuity, or life insurance policy, to terminate the contract within a specified number of days after delivery, typically 10 days, for a full refund of premiums paid. This provision gives investors a chance to review the contract thoroughly and decide if it meets their needs without financial commitment. If rescinded during the free look period, any market gains or losses that occurred would also typically be returned, making it a risk-free review period.